Good morning, good afternoon, good evening, folks. Yes, the three amigos are back. This is clearly one of the highlights of my week, and perhaps it's actually, you know what? This is my ab workout of the day because I laugh so hard. So, Matt, how are you?
I'm doing super awesome. Brought a guest appearance, another guest star here, the little lumberjack, just to try and keep me in line, But yeah, brought him along. Thought he could add some valuable comment.
Clearly, he's on Jenny Craig or whatever that is.
Yeah. I'm pretty sure this is the first sign of inflation. Yeah, a lack of material. I'm built a little bit differently than this.
They nailed the face, though.
Yeah,
they nailed the face.
Yeah, the face is good, but I'm bigger in pretty much every other part.
Oh, that is hilarious. And Dion, we have a new map. What's that looks pretty cool.
That's my traveling map. It's a lot thinner and it'll fit in the suitcase. I need to get a bobblehead, but when I was looking, I couldn't get the hair right. So
yeah, the hair would be tough. Yeah, that'd be cool. Well, hey guys, I think the Fed has started raising rates yesterday. You both know that I think we're in for some stagflation and ultimately a recession. I think recessions are natural. I think we're going to pay the price and probably have a longer recession than normal. And I got a question, or I should say a comment that I want to set up for topic number one. So Alan, this is your comment from 55 minutes ago. It says, if we have 2 to 3 year recession, 3 years would probably be a little long in my mind, but 2 years is possible. Yep. Somewhat worse unemployment, like 6%. All right, somewhat worse unemployment, comma, 6% 30-year money, inventory building, conflict like Russia, Ukraine. Do you see the possibility of housing going down further than the 20% dip correction expected? Maybe near pre-pandemic pricing, which would probably more like 30 or 40% dip. So we'll go to Dion first, and I'll reread it if you want me to. But what are your thoughts of Alan basically telling us a dip or a crash is coming?
Okay, at least it's not a YouTube channel trying to tell a bunch of people there's a crash coming, don't buy. So I get that it's a thought. I don't see the crash coming. Matt talked about it with the uneducated economist?
Mm-hmm.
Okay. Over 50% adjustable rate mortgages in 2005 and 6, about 4% now. We don't have the big push that's going to create the crash. We don't have anything that's going to create sudden inventory.
Mm-hmm. Sudden and cascading inventory.
Correct, right. I'm still of the mind where I think I'm going to win our dollar bet. I don't think interest rates going up, no matter how high they go up, is going to reduce demand. We don't have demand because we had low rates. So higher rates isn't going to change it. We had high demand because people had to be bribed to return to the workplace. We have record wage inflation. Mm-hmm. I've got people coming to us for our nonprofit, where 2 years ago, a $17 or $18 an hour entry-level IT job with an 8-week certificate course, so no degree or no experience, would have been great. People are refusing $28 an hour entry-level IT jobs with that same 8-week certificate where they did a night class for 8 weeks to get the job.
Wow.
So we're seeing wage inflation across the board. That's not going down. Mm-hmm. I'm not going to predict another 10 or 20% growth next year, but in my sector, it's happening. Our 60 employees, we've had to do it at least a 10% across the board. We're considering another 10%, trying to find out where those funds would come from. Just not only to attract people, but to retain people.
Yeah, keep. Yep.
And we hear more and more with our nonprofit people saying, why would I take a $20 an hour any job if I can get an $18 an hour job at a fast food restaurant? Mm-hmm. So I still don't see the crash unless adjustable rate mortgages become the norm, and people set themselves up for failure in 3 years. And while lenders are pushing for it, I don't see it yet.
Yeah. So a lot in that. I'll go after Matt. What do you think, Matt? Again, Alan's basically saying all kinds of bad stuff. It really sounds like Alan is expecting a 20% correction, but he's hoping for 30 or 40. What do you think of all that?
Yeah, I don't see 30 or 40. I think that's going to be a very fine threaded needle in a market that does 30 or 40. I don't think there is one. There could be, but I don't survey and I don't look at every market in the country.
Yeah.
So I don't think that's possible. I think it's, like we've talked about. So I think that I was watching a report and I think that they were talking about the fact that inventories are only going to be slightly up this year, and so again, supply demand is undefeated. So I think that so long as you have tight inventories, so long as you have wage growth, I think even at, let's just get nutty, 10% unemployment.
Yep. Okay.
You still have 90% of people employed.
Exactly.
And that's why when people start freaking out, 6% unemployment, like I get it. Like that's 6% unemployment is really important if you're looking for explosive growth.
Correct.
Right. 6% unemployment is not a thing when you're not looking for explosive growth, even if you're just maintaining.
Yeah.
And even if you get to, like, in all honesty, even if you get to 10%, like that then starts to cut. But there's still housing formation. There's still people that are getting raises. There's still 90% of the workforce that is getting paid more. So even the 20%, guys, even the 20% is not going to be until maybe the middle to end of 23, not 22. 22 is largely off the table because it's been studied through history. It takes about 6 months. It takes about 6 months for prices to really truly start declining, unless there's like this cataclysmic event.
Yeah.
So I just don't, I don't see it in 21, 22. I didn't see it in 21. I don't see it in 22.
Yeah.
And 23 maybe, but I still called for single digit growth this year. And even if it's front loaded, Mike, what are we up already this year?
Oh, it's got to be 11%. Something like
We're
that.
up 11 or 12% this year. So I'm even saying that, my number for the end of the year, if I'm right, I said, 6, 7, 8% maybe. That means we're coming off of where we are now.
Yeah. Yeah.
Maybe.
So,
I don't love the call rate, especially with, I cannot believe a 0.25% raise.
Oh,
that is a miss. That is a big time problem. And when the market reacts like it did, up 400, you did the wrong thing.
Absolutely. You bailed out Wall Street, not Main Street. So
agreed.
I wanted to kind of break down Alan's comment here, because sometimes it feels like comments on my channel are kind of trying to lead the witness. So I'm going to break them down. Do I see a 2 or 3 year recession? I see a potentially 18-month to 24-month recession. Although let's be clear, I see, given the Fed's current handling of rates, at least a year, possibly 2 of stagflation. And to be very, very clear, when you have stagflation, you can't have a recession. They don't overlap. They're not connected because part of stagflation is growth. And the definition of a recession is negative. So they are not connected. They can be kind of connected timeline, but they're not overlapping, right? It's just
one or the other.
People get that wrong all the time. So that's true. 6% 30-year money. I think we could be there this year. And again, as we are seeing this year,
6% rates this year
could happen this year. Certainly for investors, which would mean 5% for owner occupiers, right? And I play in the investor world a lot. I think so. Something important happened yesterday with Matt, the mortgage guy. It was our 3rd video, and it might have actually published this morning. I don't remember what order it was, but he got a series of phone calls from real estate agents and other brokers saying that buyers are finally backing out. What we've been experiencing, in my opinion, is demand because of the Fed. I do think the Fed created unreasonably low rates. It made it cheaper to buy than rent. Then we created this pandemic, which made me want to leave expensive and go to cheap places, hence leaving California, going to Arizona, Tennessee, Texas, wherever. Just you forced it. And people, if you're going to rent a shoebox for $5,000 in San Francisco, you can go get a McMansion for $3,000 in Texas. Stop being a renter, you become an owner, you win. So all of that, in my opinion, was because of cheap rates. But what just happened with rising gas, rising food, rising this, rising that, and rising rates is buyers are like, I give up. I can't afford it. And we're going to lose people at the margin, right? Every point that goes up, you get buying power that goes down. It doesn't mean a crash. Alan, there's no freaking crash. There will be no 10% crash, let alone what you're trying to set me up and agree with 20. Not happening. You may have a couple of cities, MSAs as they're called, that are negative this year. I don't even think you have any that are negative double digits this year. You could have some that are negative double digits next year, because to Dion's point, What makes a crash happen is a sudden wave of inventory into retreating demand, and the inventory doesn't stop. A la 50% adjustable rate mortgages, all of them reset, they come on, like the uneducated economist has talked about. Even unemployment goes to 10%. Let's just play that out. First off, unemployment goes to 10%. Half of those are renters, not owners. So it's not like you as a employer, you go, oh, you own a home, I'm going to lay you off, and not you because you're a renter. That doesn't happen. So now you have half of the unemployed that are owners versus renters. Most of those people that owned bought in the last 2 to 3 years or refied. 72 or 73% of all loans have been recast in the last 24 months. So that means you have a mortgage rate probably sub 3. And oh, by the way, just because you're unemployed does not give you permission, generally speaking, to live in a car. You got to live somewhere. So most people that are in that situation are better off finding a way to pay their mortgage. And that probably means getting roommates, having somebody in the family come in. Or maybe like Dion did, you rent it out and then you go live somewhere else while you look for a job. So there's no 20% crash coming, Alan. I've never said that. I won't say it. There's not even a 10% crash coming this year. And there's no chance of a 30 or 40% dip, in my opinion. So real estate slowdown, yes. Inventory building, yes. Days on market going up, yes. Price adjustments more common, yes. Finding motivated sellers easier, yes. But none of that means 20, 30, or 40% drop. Dion, any kind of thoughts on my big rant?
No, it's a good rant. There's a YouTube content creator named Richard Fain. I don't know if you've seen his stuff, but I watch him a lot. He's just a really laid back guy. If you wanted like cool investor, that's the guy I watch. He invests in a bunch of different asset classes. About a month ago, he made a video where he was going to sell all of his real estate to just buy stocks because inflation is causing stocks to go up. And luckily he decided not to do that. But about a week ago, he made a video. He's going to sell his house because of the appreciation. He's made so much money. He's going to sell it. Then he's going to rent for 2 years. And when prices come down, then he's going to buy a nicer house. So that was his. So I want to do a reaction video to, like the Three Amigos, maybe on my channel. That's what I was thinking maybe we would do today too, now that I remember. But he made a video a couple of days ago breaking down the logic of why that won't work and why he can't sell his house.
I know exactly why it won't work. And I have not seen, don't know who this guy is.
Would you like to try to guess?
Absolutely. So again, I get the logic, right? I'm up 300 grand. I want to take the money off the table and go rent. Well, guess what? He probably lives in a nice part of town. So anywhere he would want to rent, he doesn't want to go down, right? Most people aren't willing to trade down. So he looks for rentals and goes, oh my God, rent is more expensive than my mortgage, and probably by a large amount. And that makes perfect sense why he stays put, just for that one reason. There's no inventory, and the inventory that is there is far more expensive, and he'd be going backwards.
Word for word, right out of his mouth. Yeah. I looked for a rental. I was expecting to pay $2,500 a month. They were $35,000 to $4,000 a month for a less house than the one he's in. And then he went through, he has so many followers, it probably wasn't my comment saying, if rates go up, that doesn't mean prices are going to come down. He said there's no guarantee prices would come down in 2 years. So he's staying in his house.
Shocking.
Which means a lot of people are doing the same thing, and they're looking at I'll just rent, sell, I'll take the money. Well, they can't because rent costs more.
They're stuck.
Correct.
Which limits inventory further.
And we're going to talk about that in video number 2, I think, because I think the Fed has created a huge inventory problem that will be a decade in the making.
And the bigger issue too is that when he leaves, that's $300,000 of profit. Buy a bunch of that to taxes.
And the cost of selling. Yep.
Right. But yeah, well, it's 8% cost of selling. So if he's got a, let's call it $1 million house, and he's going to pay 8%, that's 80 grand. And if he's making 300, that's 220. But guess what? You're still going to owe taxes on the 220.
Now, in fairness, assuming he's been in his house for 2 years and it's his primary, it's tax free.
True. If he only made 300, that's true. Yep.
Yeah.
But if he makes anything more than that, because I've talked to a couple of folks left coast, and they were a couple $1 million homes that they
Oh, for
bought
sure.
for $1.3 million, $1.4 million.
Happens all the time.
And it's not this amazing house either. It's just in a really expensive area.
It's the dirt.
And yeah, exactly. It's the dirt. And so they're like, Matt, I could walk with $1 million. And I go, whoa, relax. You're not walking with $1 million. You're 80% off. You're 8% off the million. And then of the 420 remaining, you're a big chunk off of that. What capital gains? 20% off that
20,
too.
Yeah.
I mean, I said, you're writing a check for probably $250,000 to walk.
Yeah.
And where are you going to go? That's always the question. Where are you going to go and what's it cost?
Yeah. So at the end of the day, a significant recession after a year to 18 months of stagflation is not going to create the wave of inventory that would cause a pricing crash. Everybody hears me say housing slowdown, and their freaking mental jujitsu means a housing slowdown equals crash. No, folks, we're just going to go from 18 days on market to 36 or 50, which, oh, by the way, some markets normal is 75. So,
right. Well, and also to that point too, Mike, you're also talking about 3 million transactions we did last year, 6.364. Let's just say we drop 1 million homes fewer.
Yeah.
Then guess what? You're back to 2021 or 2020.
Yeah. It's just, yeah.
And you can go another 500,000 fewer than that. And then you're in 2019 levels. But again, that's not pricing. That's only transactions.
Mm-hmm. Exactly. There's a very big difference. We could have a housing crash in transactions.
Mm-hmm. Sure.
I hope people hear this. Transaction doesn't equal value. And then the last thing to say about a recession is you will see the stock market get hit hard. You will see companies that were funding because they can borrow get hit hard, but none of that means a real estate crash is something. I know there's lots of you that want pricing to come down, that you feel like you missed the boat. I get it. Unfortunately, I don't have good news for you. I don't see a 20, 30, or 40% recession or crash, even after 18 months stagflation, an 18-month recession. So this is now March 2025. If you've been waiting 3 years, I'm going to guess real estate is up 10, 15, 20% from today. That's only 3 or 4% a year. So I don't have good news for you. If you're hoping for a crash, I'm not your guy. Dion, how can people find you?
Right here on YouTube, Dion Talk Financial Freedom.
And Matt, you?
Lumberjack Landlord on YouTube and Lumberjack Landlord on Instagram.
I have to say, I hope you make those little lumberjacks available because I know a lot of people would want some of those.
So we are, and it was just one of those things where I'm not so narcissistic that I had to have a little me running around. He doesn't run, he's stable. And I've got 3 real little me's running around.
Yeah.
And that's more than enough. And so, we got a couple other prototypes coming in from a couple other places. And, the losers my kids get to play with.
There you go. All right, guys. Thank you very much.
Thanks, Mike.
Yeah.